My name is Nick Iverson and I am an enrolled agent. Today I want to talk about the tax consequences of selling your home. If you are considering selling your home in 2016 or have already sold your home this year, you may have wondered if there are any tax consequences and what they might be. Generally speaking, if you sell your main home, you may be able to exclude from income any gain up to a certain dollar amount, determined by your filing status. Let's start by defining the term main home. Usually, the home you live in most of the time is your main home and can be a house, houseboat, mobile home, cooperative apartment, or condominium. Once you have determined if what you are selling is your main home, you must figure out if you have a gain or loss on that sale. To figure the gain or loss, you will need to know the selling price, which is the total amount you receive for your home. Selling expenses, such as commissions, advertising fees, legal fees, and loan charges paid by the seller. The amount realized, which is simply the selling price less selling expenses. And the adjusted basis. Generally, your basis in the home is its cost if you bought or built it. If the home was gifted to you or inherited by you, the basis may be its fair market value or the previous owner's adjusted basis. While owning the home, you may have made increases or decreases to your home's basis. Figuring basis can be complicated, and you may choose to reach out to a tax professional for assistance. The formula looks like this. Selling price less selling expenses equals the amount realized. The amount realized less the adjusted basis equals your gain or loss. If the amount realized is greater than the adjusted basis, the difference is a gain, and you may be able to exclude part or all of it from income. Any part of a gain you cannot exclude, in most cases, is taxable. If the amount realized is less than the adjusted basis, the difference is a loss. A loss on the sale of your main home cannot be deducted. If you have a gain and your filing status is single, you can exclude up to $250,000 from income. If your filing status is married filing jointly, you can exclude up to $500,000 from income. You must meet 3 qualifications to be eligible to take the exclusion on a gain. The first is known as the ownership test. During the 5-year period ending on the date of sale, you must have owned the home for at least 2 years. The second is known as the use test. During the 5-year period ending on the date of sale, you must have lived in the home as your main home for at least 2 years. Finally, during the 2-year period ending on the date of sale, you must not have excluded gain from the sale of another home. Generally, if you can exclude all of the gain, you do not need to report the sale on your tax return. If you have a gain that cannot be excluded, it is taxable and must be reported. If you fail to meet the exclusion requirements, you may still qualify for a reduced exclusion. This applies if you fail to meet the ownership and use tests or have used the exclusion within 2 years of selling your current home. However, to qualify for the reduced exclusion, the sale of your main home must be due to a change in place of employment, health, or other unforeseen circumstances. There can be many complications resulting in the sale of a main home, including marriage, divorce, disability, death, temporary or non-temporary absence, or military service. If you have questions related to your specific situation, please contact your tax professional or click here to schedule a free, no-obligation consultation. For additional tips and tax-saving strategies, be sure to sign up for our monthly newsletter and subscribe to our YouTube channel for weekly updates. If you have any questions you'd like us to answer, please leave them in the comments below.